Once an individual starts earning, exposure to personal finance management ensures that the individual also starts saving and investing a part of their earnings. However, when starting on their investment journey, there are plenty of mistakes that a person can make, since it takes time, patience, and experience to excel in the stock market. In this video, Bullsmart shows you 5 common mistakes made by first-time investors. The most important rule to follow when starting your journey in equity market investing is not to follow blindly what others are doing. Instead, develop your conviction. Herd behavior refers to the tendency of individuals to mimic the actions of a larger group, often without fully considering the consequence of their actions. In the stock market, herd behavior can occur when investment decisions based on the actions of others rather than on the analysis and judgment. For example, if a large group of investors start buying a particular stock, this can drive up the price and lead to more investors buying the stock, resulting in a price bubble. On the other hand, if a large group of investors start selling a particular stock, this can drive down the price and lead to more investors selling the stocks, resulting in a price crash. It is important not to give in to herd behavior in the stock market because it can lead to irrational or emotional decision making and can result in financial losses. Instead, it's important to make investment decisions based on your analysis and judgment, and to have a clear investment strategy that aligns with your long-term financial goals. It's also important to diversify your portfolio to spread risk and to have a long-term investment horizon to potentially smooth out short-term market fluctuations. Diversifying your asset class in stock market investing means investing in a variety of different types of assets to spread risk and potentially reduce the impact of market downturns on your portfolio. Some common types of assets that investors may choose to include in their portfolio include stocks, bonds, cash and cash equivalents, mutual funds, commodities, and alternative investments. Each asset class has its own set of risks and potential rewards. And by diversifying your portfolio, you can potentially reduce the overall risk of your investments. For example, stocks are often considered to be a higher risk rather reward asset class, while bonds are generally considered to be a lower risk, lower reward asset class. By including a mix of both stocks and bonds in your portfolio, you can potentially reduce the overall risk of your investment while still having the opportunity to earn returns. A common mistake that first-time investors do is to think that investing in stock markets is going to make them rich quickly. It's important to understand the risk resolved. Volatility is the essence of the stock market, which can increase or decrease the investment values significantly, especially over short periods. It's a good idea to have a long-term investment horizon and to be patient with your investment. While it's possible to make significant gains in the stock market over the short term, it's generally more realistic to expect to see returns over the long term as a result of compound interest and the natural growth of successful companies. First-time investors tend to buy shares of the company they know about. They start investing in different assets like stocks, mutual funds, real estate, etc. with no definite plan in mind. Instead, there has to be a defined plan on how mutual funds are going to be concentrated in which asset class. It's important to note that there is no one-size-fits-all approaches to asset allocation, and the appropriate mix of asset for your portfolio will depend on an individual financial goals, risk tolerance, and other personal factors. The first-time investors generally fall into two opposite spectrums. On one hand, we have the hyperactive investor who continuously track their investments and end up taking rash buy or sell decisions. On the other hand, we have a certain investors who completely forget about investment and do not look at it for months and years. Both of these approaches leads to suboptimal investment returns. It is important to not be in either of these camps and instead strike a balance between the two. The above listed mistakes are some of the common ones which first-time investors tend to make when they start their investment journey. Hopefully, all of us can learn from this mistake committed by others and grow as a smart investor. Finally, don't rely on luck. Investment smart with Bullsmart. Stay tuned with our channel for more investment tutorials.